Welcome, everybody, to the High Return Real Estate Show. This is Shecky. I am without my illustrious business partner today, Mr. Jack Gibson. He is out traveling, I don't know, somewhere in the Caribbean or somewhere fun like that, but we did give him the day off. But I'm excited to have a really great conversation with a gentleman that I met actually a couple of years ago. And we've been talking about getting him on the podcast. And for whatever reason, with his busy schedule and mine and just the craziness of running our businesses, we have not made it happen. So it's one that I have been looking forward to for a very, very long time. This man has extensive experience in property management, extensive experience in acquisitions, and extensive experience in buy and hold. So I know that's how does somebody fill shoes that big? But you wait, you'll see what I mean when you talk to this guy. So I'm very, very excited to have him, and we will have him on here in just a second.
Welcome to the High Return Real Estate Show, the podcast for heavy hitters. Two men, one mission. It's time to build your empire.
So welcome back, everybody. Thank you so much for being here. And today I have the pleasure of introducing Mr. Noel Christopher. How are you, Noel?
I'm doing great. How are you? Great to be on the show. I really appreciate it.
Yeah, I'm happy to have you. I know I've been talking about it for a long time. So you have this illustrious career in real estate investing world and have worn many hats. And it's amazing to me that you continue to add more hats. I don't know how it doesn't squish your head, but clearly it's worn all the hair off. So I know you're involved with a company called Renters Warehouse, and I want to hear more about that, but there's a much, much bigger picture to that. So, if you don't mind, rather than me boasting about you, because that's all I'm going to end up doing is boasting, can you tell us a little bit about your background and how all this came to be and how you got into the position that you're in now?
Absolutely. So, I've been in sales for a long time. I used to work for a company that actually, I kind of started in my sales in real estate, was working for Tom Hopkins. And some people here may or not know who Tom Hopkins is, but he wrote the How to Master the Art of Selling book, How to Master the Art of Selling Real Estate. And he travels around and gives sales training seminars around the country. And I, at pretty early in my career, I was hired on with Tom Hopkins to be a sales trainer. And so what that really meant is I was a traveling salesman. Door to door. I had an inside sales guy who would set up meetings for me, and I would go out and give pitches to car dealerships, mortgage companies, real estate companies, anybody who had a sales team that was on the ground out there trying to close deals. And it was really about giving them a little snapshot of what they could get at the seminar, and then I would sell the seminar. And I would also sell books at the same time. And it was as close as you can get to selling vacuum cleaners door to door. But I was doing.
Yeah, it's a great model, though. That model's been around a long time.
It's been around a long time. So yeah. You want to hear something a little about Tom Hopkins? I would go in and then close them. And I would say, here's the close. And I would hold up Tom's book the entire time and say, Tom says. And then I would sell a bunch of books, which was my beer money. And then I would sell tickets to the seminar, and it was both a combination of sales training, so it was for sales managers, and then for actual sales reps. And so I did that for a few years, and that got me the taste into real estate. And I ended up moving to Chicago, which is one of the markets I worked at for Tom Hopkins, which I go live there for 3 or 4 months, integrate into the market, sell the seminars, do the seminars at the end, go on a little vacation, then go to my next market. And it was something you can only really do when you're single and right. Traveling around. And Chicago is a market I went to. I loved it there. I'm a ex-ski racer and a rugby player. And at the time I was very heavily playing rugby. And so Chicago's a hotbed for playing rugby. And I loved it in Chicago. I ended up, instead of doing I had about a 2.5-month vacation time in between markets. I just stayed in Chicago for the whole summer. And I ended up getting a job with basically a placement company that places, employees and things like that, like recruiting, things like that, but it was technology placement. And that right after I got that job and I was there for a few months, September 11th happened. and it just wiped out. It wiped out this company. It wiped out several companies that were requiring temporary workers, contract workers in companies. As the economy took a huge hit at that time, everybody just shed their contract workers, and we got killed. So I ended up working for one of the companies I did sales training for, which was called Inland Real Estate. And I had done an extended version of the sales training for them. I gave them the short 2-hour sales training. Then they went to the seminar, and then they hired our company to give them more in-depth training. So I spent about 2 months in this company's office of commercial real estate. And it was so exciting. Even though I had done real estate sales training, I had never worked in the real estate industry. And just seeing the deals and the things that were happening, I ended up going, and I kept in touch with that company. And when I needed a job, I went back to them, and I became a commercial real estate broker in Chicago, which, if you know Chicago, commercial real estate, you can kind of put it up there with New York. It is a dog-eat-dog world, and it is ruthless. And, I was working a night job at a bar, at a nightclub, and then in the day selling commercial real estate, and it was just brutal. And that's kind of where I learned my chops and earned my, that hustle that you need to have, and the ruthlessness. You just have to be so ruthless to get ahead. And so I did that for a while. And that's when real estate was really hot, and it was turning into where, in 2005 and through 2004 through 2008, it was really just, I started going out on my own. I was doing deals. I was buying commercial buildings, buying apartment buildings, buying bars and restaurants. Just doing everything in real estate we could. And when the real estate crash happened, the commercial world got destroyed, as well as the residential. And I was dealing with a lot of investment, but I had done I dipped my toe into the single family rental investing, into the investment real estate. Once the downturn happened, you couldn't get a purchase loan, but you could get refi loans. So you could own an investment property and refinance it, rate and term, no cash out. And so I worked with a group of guys in a company called Select Funding in Chicago, and we started buying foreclosed homes, finding investors, maybe people who saw something going in their 401k, but they had nowhere to put their money to invest. We would get them a hard money loan. We would buy the building, we'd rehab it, and then we'd let them refinance out. And I just acted as a developer. We weren't taking any money on the back end because you couldn't even get a loan like that. And we did about 300 buildings in Chicago, 2 and 3 flat buildings, and it was a turnkey business.
So were those mostly single family homes running through that division?
No, they were mostly 2 to 4 flat buildings, mostly 2 and 3 flat buildings.
Okay.
In Chicago, that part of the economy got just wiped out. There's a ton of vacant buildings still in that business. And so we're going in up and coming in fringe areas, buying these, getting them rented out, stabilizing them, letting them refinance out. And we were just churning and burning that stuff. And that really got me into the investment space. And then in 2011, I started working for a company called Century 21 Affiliated, which they had, and I liked them because they were commercial guys. They bought into this franchise, and they wanted to expand it. So we're buying other brokerages, which is something I'm doing currently now with Renters Warehouse. We were really expanding, and I had been working in the investment world, dealing with a lot of foreclosed homes and trading properties and building. And I had started to dip into the single family quite a bit because it was just a little bit more of a stable tenant. You could be in the suburban areas, a little more stable areas. And I was on vacation with my wife, and I got a call from Blackstone, who had been referred to me by an attorney. And so the rest is history there. So we started buying homes for Invitation Homes, which was Blackstone had backed them in Chicago in late 2011, early 2012. And we, ended up buying about 900 homes with them, plus another couple of thousand with other investors. I got involved in the neighborhood stabilization program and really decided at that time that this was a space that had so much room to grow and so much possibilities to grow into that. And so, and I've been doing that ever since.
So just so the listeners understand, like when you mention a name like Blackstone, I know it means something to me and you, but explain your excitement of why working with Blackstone was so huge, right? Because the listeners may not know what this is all about.
So For one, I didn't know who Blackstone was. I mean, I had heard of them, but I didn't know who they were. And I kind of pushed it off the first phone call because the model in my mind was, they said they want to buy a bunch of single family homes and rent them out. And it didn't make sense to me until I started doing some more research and seeing that, it's such a fractured space. There's a need for housing because of the pushback because everything that happened in 2005 to 2008, all the builders stopped building, and there was anybody who was smart was talking about how there's going to be a lack of housing coming up. And we're seeing that. And it took a while to hit it. But these institutional funds like Invitation Homes, American Homes for Rent, a lot of these big companies, they set the bottom of the market in a lot of the markets around the country. So in Chicago, for example, when we came in and we started buying 250, 300 homes a month, that set the bottom of the market and everything started to recover from there. And they didn't need to do this. They did it in about 13 markets. They did not need to do it nationally, but it really set the market nationally. All these funds buying, and Invitation Homes bought about 50,000 homes. Now through consolidation with some other funds, they own about 100,000 and maybe even more. And so these institutional funds saw the model. They saw the opportunity to buy the homes at a low price. They knew there was going to be appreciation. A lot of people were predicting that it was just going to be a trade, that they were going to buy these homes, fix them up, they would appreciate, and then they'd sell them back on the owner-occupied market. But being in the inside, we knew that this wasn't a trade. There are now currently about 16 million single-family homes in the country that are owned by investors. 50% of them own 1 to 2 houses, 80% own less than 5 homes. If you add in 2 to 4 unit buildings, it's about 23 million homes. That 90% of them are owned by investors own less than 10 homes. And these big institutional funds maybe own about 300,000 homes out of the 16 million. So they're a small blip, but what they did is they set that market. They allowed now debt products to come into the marketplace. They started lending, Colony, which is now CoreVest, B2R, which is now American Home Lending. There's several others. And now even I can tell you this because we've had these conversations, some of these non-bank lenders that only do single family owner occupied homes are going to get into the space. And so they set that market. They start to institutionalize the asset class. This is one of the last asset classes of real estate that hasn't been institutionalized. And that's a positive, or being institutionalized is a positive thing. It brings liquidity to the market. It brings opportunity. So now fast forward, I'm at Renters Warehouse. I started working with Renters Warehouse about 3 years ago when I saw that, I actually met their private equity group before they bought Renters Warehouse, Northern Pacific Group, the actual day before they bought them. And I ended up working with Renters Warehouse because in the property management world, just like the single family rental space, is very fractured. The level of service is pretty low. There is a need for a company like ours we're in 41 markets where you can own one house in 41 you could own 41 houses in 41 markets and have the same level of service on the property management and operations.
Right. And have the same property manager.
And have the same property manager.
Same parent company, at least.
Same parent company.
Yeah.
Same point of contact. So the level of service is being raised in the space. There are more companies coming in like ourselves that are seeing that, okay, there's a lot of regional companies now that are getting bigger and they're going to get gobbled up by bigger companies. And the next phase of that was marketplaces. There was really no place, if you wanted to go buy single family rentals, if you didn't know about Indianapolis and know about you, where would you go? Where would you go to go find a house to buy? And so that born a lot of fly-by-night turnkey companies, which has not been great for the industry.
Yeah, which there are many. I mean, we don't think we're fly-by-night.
Of course not.
We like to think we do things right. But yeah, you're right. It's really we're identifying other markets that we are definitely going to go into, but for a small family-owned operation like ours, and kind of we're growing more like middle size now, but even so, there's no way you can just go national overnight. So
no, you can't.
And a lot of relationships to make that happen.
It's a ton, and it's so local that you can't just replicate a model and just say you're going to do it everywhere. I mean, you have to really understand the local market and the nuances within that market.
Yep.
So what's interesting that's happening now in this space is that So you have a company like ourselves, you have Roofstock, you have, there's really not that many other ones, but it's interesting because there hasn't been a place for real estate agents who focus in this space to go to. There hasn't been a place for investors who want liquidity with their properties. So what's the good and bad part about the single family rentals? The good part is that it's very stable compared to the stock market. Stock market's going up and down, up and down. People are losing money, earning money, but it's not person on Main Street that's affecting. The single family or the investment properties it just kind of stays steady. It might level off a little bit. It stays pretty steady. And as long as you're doing things right operationally on the rehab, you're going to be okay. Now with some of these marketplaces, it's adding some liquidity into that equation. So now you have a space where you can go and sell your investment properties if you choose to and buy others. We're seeing with the build for rent, which is becoming very, very popular, that's allowing some more of the funds that have been on the sidelines trying to wrap their head around scattered site rentals. Because if you think about it, like owning an apartment building, everything's in one spot. It's easy to manage. Owning single family homes, you could be over 50 square miles and you're trying to figure out how to manage all of that.
Right.
Step in, build for rent communities, which fills that gap, and there's still a need for housing. So we're seeing a lot of multifamily type funds come into the space. I mean, I can tell you this, just in general kind of state of the single family rental market, I have not seen since 2012 to 2015. And I was not only involved in Chicago buying, we were doing stuff all over the country. I have not seen this kind of enthusiasm since then, right now, today, on investors wanting to get into the space. And a lot of people ask why, if there's maybe there could be a recession coming. Well, real estate's a very stable asset to own during a recession. Your rents compared to multifamily, your rents in single family rarely go down. They might level off and not appreciate as fast, but they're rarely going to go down because you don't usually have an oversupply issue. And especially now, because everybody's been so careful and the lending practices have been so careful, the issue in the real estate market right now isn't a bubble of speculation. It is a supply issue. It's a little bit harder to build, a little bit harder to find homes. So the prices have gone up.
Yeah. Yeah, it's great. And I love to know that the demand is there, obviously, because we're selling to that demand. So,
oh, absolutely.
We've had stuff that like one time, I mean, I send out all the emails for our buyer list. And we literally, I don't know, it was like maybe 4 or 5 months ago, we had a property that we sent out an email on, and we had a signed purchase agreement in 8 minutes from the time that email got signed purchase. No, not, in other words, not somebody just saying, yes, please send me the investor packet, right? So I'm clearly not saying that to dissuade anybody from wanting to ask for investor packets, of course, but what I am saying is I'm speaking to what you're saying about this demand. And I think you're right. Much of it is fueled by the volatility of the stock market. And it's hard to find a place where you can park some cash that you really know is going to be safe and solid and historically has grown and built wealth, anything like real estate has.
Well, what a lot of people don't realize, their memories are so short, and both positive and negative. So back in 2008, we had just a terrible recession. There's a lot of things that was backed off of, and housing was a big part of that. It was a lot of speculation. Lenders were giving away loans, not checking people's credit. I mean, they were checking their credit, but nothing else. There was overbuilding going on, and a lot of other global factors. That has never happened before in housing. There's never been a crash like that in housing. And if you go back 50 years, the appreciation has just kind of gone like that 3.2% or so, and it's been doing that for a long time. And then the last 8 years, it's gone way up, right? But it still hasn't gone way up where it's speculative. If you look at that average over 50 years, we're right in line with that trend line. And I get in this debate with a lot of people, especially journalists who take snippets of housing data and use that as a thesis to say there's going to be a housing crash. Again, it's a supply issue. There is a huge amount of need for houses for people to move into, to live in, whether it's going to be rentals or to own. Not everybody is set up to own a house. It's not always the right thing.
Yeah.
Remote working has become more popular and better. You can now, as millennials are going to places like Indianapolis that have great jobs, they're a lower cost market. Maybe they don't want to own. Maybe they want to rent and then they buy investment properties. We're seeing a lot of that.
Yeah, Noel, you bring up an interesting point too, because, obviously with the gray hair and all that, like I'm a baby boomer. So my generation and my parents' generation, it was all about buying the house. Like that was part of the American dream. And I feel like that's changing for millennials and for the younger generation. Like it's not that big of a deal. Even if you go back to like the basic Robert Kiyosaki stuff, and he talks about, your own home being a liability because you've got taxes, insurance, and repairs and all that. And sure, you do on an investment property too, but that's more of an asset because it's bought with the intention of making money. It's not bought with the intention of living in it so that you could lose money. And I think that, to a certain extent, obviously realtors, especially what I call the retail realtors, are all about making commissions. And I think, they've been slinging this mantra for a very, very long time. And I don't think it's necessarily true that, owning your own home is the biggest single most important investment you'll make in your lifetime. I think that's kind of a bunch of BS.
Well, it's the biggest liability. I mean, and it's funny because I get because I post a whole lot on social media about real estate investing and what we're doing. And I get some people who come to me or on LinkedIn just recently and said, rentals ruin the community. People need to own home. We need to get back to the American dream. To a point, I agree with that. I think that if you leverage yourself to own a home, which you don't necessarily own, and you cannot afford and you have nothing left over to invest, you're shortchanging yourself. I think it would be better to, and then not everybody agrees with me on this either, even some people in the investing world, it would be better to buy rentals and create a portfolio so now you can own that home. Now, there is some benefit to maybe leveraging to a certain point that home, because if you own a house that is worth $800,000 and you've got $500,000 in equity and your house goes down in value $300,000, it doesn't come out of the equity that you owe the bank. It comes out of the equity that you have in the house. So there's a balance there. I'd be interested to hear your opinion on this, but there's a balance of leverage. And this gets into real estate investing as well. Like we don't suggest, and I know you don't suggest somebody to leverage all the way up to the very end. I don't look at it, and maybe you look at it differently, I'm not sure, but I look at it as you figure out how much money you put down based on how much cash flow you need to support that asset that you have over time, not cash flow you need necessarily in your pocket, but especially on the first house. So we're not always telling somebody, well, you should put down 30%. It's like, well, what does 30% mean to that investment at that time?
Yeah, I 100% agree. I think there's too many people out there that are overextended. And we've even seen people, I know investors personally, that have bought from us that probably overextended themselves on that first buy. And I didn't necessarily know that going in. And, like they have to live off of the rental income. And, it becomes part of they look at it as income. Certainly, there's a lot of marketing out there, and we do it too, and we talk about passive income on our website and things like that. But those concepts can be abused and taken a little bit too strongly,
especially in the beginning.
Yeah.
So you get 5 properties in 5 years or 10 properties in 5 years. It starts to get interesting after 5 years on even just one property. So that's something that we've been trying to educate people on as well, because you do have some bad actors out there. I don't know if I want to call them bad actors.
No, I mean, it's just that there's extremes in every case. Right. And I think that it's easy to look at the extremes and think that everything's going to be perfect. But I would never want an investor to be in a situation where if let's say they have 1 or 2 properties and they're either one or both are vacant for any length of time, that then they can't pay their own light bill at their own house. Like that's a problem. So that's the wrong kind of investing. You're just too overextended. I have another question. It kind of goes back to what you were talking about, the crash. And I know we're a little bit all over the board here, but when you spoke to all the crappy things that went on in the 08, 09 crash, and obviously if you could fog a mirror, a lender was giving you a loan on a house. And,
Right.
and I know that a lot of the laws have since changed, and supply and demand is different now and all that. And I get that, but I still feel, I know you don't necessarily agree with me, but I still feel like there is some sort of crash happening only because what I've been recently learning about the banking industry. So, in the US, we know that this is a very, very protected industry. The government basically bails them out every time they screw up. And they're almost like licensed thieves, in my opinion, because basically what they do is they take depositors' money and they are irresponsible with that money. And here's what I mean. So back in the other crash, they were keeping about, I think it was something like 1.9 to 2.5% in reserves before they were, out
Right.
investing that other money. So what that means is if you deposited $100 into a bank, they were then investing out $98.50 out of that 100. So they only kept $1.50 as far as quote unquote liquidity of your money. If you wanted to go back and take that $100 out, there's a little bit of liquidity there, but if you ask for all your money back out, there's a high likelihood that you won't get it.
If everybody asks for their money back.
If everybody asks for money, we're in big trouble, right? So, and then then the government comes in and bails it out, and the government's actually funded by me and you and all the other taxpayers. So it's this horrible financial formula. So what I have come to learn is since then is that the reserve now is even smaller. So even though the banks did some really, really stupid things in 08 and 09 that caused a horrific crash, both in the general economy and in the real estate world, they're now sort of following these new rules, but now the reserves are down at 0.8%. And somehow this is legal. Like, this is what blows my mind. So the government comes in and puts in all these new laws to quote unquote protect the individual. But I feel like we have more exposure in that regard than we've ever had before. So now they're only keeping 80 cents out of that $100 in that same example. So how are we now in a better position? Like, aren't we just in the same position? Just, it's a different wolf in sheep's clothing. I'm not sure how to ask the question, but you see what I'm getting at.
So add in record consumer debt, student loan debt, false, I guess I want to be careful how I say this, false corporate profits.
Mm-hmm.
It's more leveraged to more stock buybacks, and it's been something we've been talking about a lot. I think that the Fed is kicking the can down the road, and I'm going to answer your question on the banks in a second. They've been kicking the can down the road, and like some point there's going to be a pain point. I agree with you that the shell game that the banks are playing, and that the lobby of the banks are so big. I'm not an expert in that area, but it is a hugely risky area. And if the banks cannot lend money, that directly affects the housing market. I mean, just if you can't get a loan, the housing market, there's going to be some serious issues.
Yeah.
I think that because of the protection that the banks get, and because there's still a huge amount of demand in the housing market, and there's a lack of supply, and we can get into the baby boomers not selling their houses like they used to, and having a type of a house that isn't as attractive to the new first-time home buyer. It used to be like people would buy a house and it would be their house they'd live in for a long time. It was a modest house, and that was it. Because of the ease of lending and the way it's been, even after the recession, people are still buying, 3,000 square foot homes in the suburbs, not even close to a job, not even close to somebody who commute to a job. Those aren't as attractive houses. So I think there's some weakness in that part of the market, but that's helped create a ton of demand. That's why places where are very commutable, where you're within an hour's drive of a city that's opened themselves up for business, or a state like Indiana, for example, compared to your northern neighbor where I came from, that is not as open and business friendly. There's going to be some differences, and you're seeing that happening all over the country, where these places, and I don't know where you've been looking at to replicate some of your model, it should be the second tier markets that are growing, where a ton of millennials are moving. And everyone talking about the millennials are 43% of the purchases right now. Well, not every single millennial that's moving to a market is buying a house, because there's some affordability issues. So they're renting as well. So there's huge opportunities for good quality housing that there's a need. I don't think that things that are happening with the economy and the global economy are going to crash housing. But the banking system is something that is always a fear, because if that goes, so does everything, right? I mean, if you can't lend, and what is our government debt, and what is the Fed doing with, I mean, if you notice, the Fed has less control when they've raised rates. Interest rates didn't go up that high on mortgage loans, really, that much. Now they've lowered them, they've kind of gone down, but there's now that with all the non-banks out there, and how much capital is out there, there's so many different factors that the Fed doesn't have as much control as they used to.
And that's a good thing. My opinion, like I love the fact that there's a lot more private money coming into the marketplace.
100%.
And, some of it's trashy. Let's just, I mean, there's charlatans in that space too, just like every other space. But I love the fact that there's a lot more private money, and the internet obviously has opened things up with crowdfunding and all this other stuff. And I'm a huge fan of cryptocurrency for the same reasons, not because I think it's like, oh my God, it's like the best investment ever, but as a model itself, to have a version of currency that is not controlled by any one particular government. It's not manipulatable. That is freaking awesome.
And that is where, there's been a lot of talk, and it depends what you read and what you believe in, about, the United States as an empire. And we're kind of getting into a whole different subject, but it's interesting because the dollar controls so much right now, but there's getting pushback, and there's different currencies being pushed and tested, and China and Iran and Russia and India, and like, forget their political, how their democracies or communism or whatever, and how they treat their people is a whole separate subject. But the currencies is going to be interesting. It's going to be interesting to see 10 or 20 years from now how the dollar is being held up, because that really affects us as a country as well. So it's just, there's so many dynamics. But again, I think that, the banking is very fearful on their liquidity, because they don't really have much. But the housing market, I think, I'm not seeing, what's going to happen. I never want to look further out than a year, because you have no idea. But the next year, I think it's going to stay pretty strong. I think that a lot of people come to me and they go, well, but what happens if I buy, and then, I buy this investment property and the numbers work today, but then the market crashes next year. I'm like, well, if you hold on to it, and you're not over leveraged, and you're not pushing like in the apartment, in the multifamily world, I mean, you've got cap rates that are 3 or 4%. Any fluctuation in rents, those guys get wiped out.
Yep.
In single family, you've got some room there. And I think that in the rents probably aren't going to go down that much, barring just a whole meltdown. They're more stable. So I think if the investment works today, and you made a smart investment today, in 1 year, 5 year, 10 years, it's going to still be a smart investment. And that's,
Yeah, I'm sorry to interrupt. I love what you said there too about the single family versus multi, because my background's marketing, obviously, and we're selling single family homes, and some duplexes here and there too, but it's smaller stuff.
Yep. And
there is so much stuff out there about how, hey, you're an investor and multi is the way to go. And think about it, it's like, man, you could have, 50 doors under one roof and you still only got one roof, versus all that, your CapEx is much lower in a multifamily, all that other kind of stuff. But the main thing that you just mentioned is never discussed, right? And that's the returns. and having the liquidity and flexibility. So like if you're a guy with 10 single family homes and you need to liquidate 2 or 3 of them, you have multiple avenues. You have your marketplace, you have the MLS, you have for sale by owner, there's like so many ways that you could liquidate those properties.
And buyers. So you can sell it to an investor or you can sell it to a homeowner.
Yeah, exactly. If you're sitting on a 50-unit apartment building, that's a lot of work to sell that baby. It's a lot of work.
Absolutely. And, we're seeing this a lot now. So we saw a lot of investors that invested in during the last downturn, and now some of them are starting to sell. And like I said before, the demand is huge, and the demand isn't, I talk to portfolio owners all the time. And the first thing they say is like, I'm not going to take some lowball offer. This isn't a fire sale. And I've been trying to explain this to everybody that will listen. Because of the liquidity coming into the market, because of more investors wanting to buy, people are buying at fair market value. What's fair market value? The first thing fair market value is, and I'd be interested to know your opinion on this, but the fact is that you're not going to pay more than the retail value. So if you own a house and it's worth, to sell it to an investor or to sell it to a homeowner, it's worth $150,000, no investor is going to pay more than that, even if the cash flow equals more. And that's where the differences in multifamily are. Because in multifamily, you have a cap rate that it goes for based on the location and the market. And so it could sell for an infinite number if you can increase the rents an infinite number. In single family, you're going to have a ceiling of that comp value. And that's good and bad, right? So as that comp value goes down, sometimes you're going to have areas that have lower values, good rents, therefore you have high yields, and those are the areas where people are buying because they're seeing a little bit lower costs. The comp values haven't shot up, but they're still getting good rents and people want to buy there. Indianapolis is a market like that right now where investors want to buy. And so I've been telling investors, like, if you're looking to sell, I mean, personally, if someone's asking me for advice, I would tell them you don't need to sell. You should just keep holding on to this. But there's a lot of different reasons people sell. A lot of times they maybe want to diversify into other markets or other asset classes. And you can now sell your portfolio of homes to an investor pretty straightforward and get a fair market value. The difference is when we talk about how the single families are nimble and you can sell off 2 or 3 at a time, sometimes people get hung up on the 1031 exchange. So now we're getting more people coming to us saying, I'm going to sell it all. I don't want to sell 1 or 2. I'm going to sell all of them because I can 1031 exchange this into something else. But still, the fact is you can still sell a few off and sell some dogs or some higher performing assets. I mean, you should be looking at your portfolio at all times and understanding what it is. If the value's gone way up and the rent is staying here and you have a pretty big upside, it might be a good idea to sell it to invest into another or more single family rentals or investment properties, whatever you want to do. But I would definitely not want to put that in the stock market because it's going to go up and down where this is much more stable.
Yeah, I think it's a good point. I look at it typically in terms of rents. I mean, if you have a market value that you can get, I don't know, $50,000 or $60,000 more for that property than what you paid for it, and you've enjoyed some years of collecting good rents, well, that $50,000, I mean, that's a lot of years of rent on one house, a lot of years of rent. So you can take that and jump up to something else that's maybe performing just as well, and then allow that one to gain that increased appreciation and all that kind of stuff.
Well, and it kind of goes back to the concept of if you've got $50,000 in equity and the value of that house fluctuates at all, the equity is the first thing that gets taken out. Right away. So you should not always have your place leveraged to 100%, but you should make sure as you're increasing, you're either re-leveraging and taking out some of that money and investing it into other rental properties, or selling and then investing into other rental properties. Because you can 1031 exchange that and you can defer the taxes just, for almost infinitely. So those are all good things. And that's where people get caught up is you've got all this equity in the house. That's not money in your pocket. You need to take that money, in my opinion, take that money and put it into something that's going to give you back and yield you. And that's where people get caught up in owning and living in the house that they're paying for. It's not a performing asset for them. And if they do get equity, it's a good idea to figure out how to leverage that in a positive way and get something that's going to perform.
Yeah, there's always everybody's got the braggy neighbor in their neighborhood. Like if you own a property, there's always that one braggy neighbor that's always I got $250,000 of equity in my house. Like, well, that's,
It's going to happen tomorrow if you have to sell it. It's not going to be, Like
Yeah, it's an illusion. Right. So
it is.
just a little asterisk to what you said earlier about fair market value. I unfortunately, although I did learn some things from it, had a couple stints in the car business many, many years back. And, talk about a rough business, kind of like what you were saying about.
I just bought a new car and I said I wouldn't buy a new car, but I bought a new car and I had to accept the fact that you're about to state probably.
Well, it's a crappy business, and it's anyway. But I always used to feel that, when you talk about fair market value, any of the terms that you want, what I was taught a long time ago, what is the definition of a good deal? And here's my answer that was taught to me, and this has really served me well. A good deal is a good deal if both the buying party and the selling party are happy with the terms. That's it.
Yeah.
So it doesn't necessarily mean you could look at, say, okay, look at all the things, look at comparative market analysis and all that other kind of stuff, and you look at performance and all that kind of stuff. But different investors, buyers, different sellers are maybe looking at things with different lenses. And that's what oftentimes investors lose sight of, is that somebody else's reasons for selling may be different than your reasons for selling when you're going to sell a similar asset.
Right.
And I think when we keep that in mind and just look at, okay, look, is everybody fair? Is everybody happy? Then we got a good deal on our hands.
Well, and we've had, since we've started our marketplace, we've had a ton of people come to us and say, okay, I want everything that's under 70% of blah, 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 or 60% of this or 80. And that's not the market right now, by the way. And if they're getting a deal at 80% below some preconceived number that they'd like to be at, they're paying for what the property's worth. There's certain situations where a seller might sell at a discount because they need to move something very quickly. We find homeowners in that situation, and that's why the iBuyers are being very successful. They're not buying the top of the market. They're buying the people who need to sell their house right now, and they can't afford to wait an extra 60 days to get it sold and make 15% more, because it just came out that the iBuyers you get about a 15% discount. Same thing goes with investors. I tell investors, they're like, well, what kind of deal am I getting on this? I'm like, well, what's your cash flow threshold? What kind of yield do you need to get? Okay, you're getting that yield and you're buying it below, it's at or below the market value, which is great, but like, what kind of deal is it? I agree with you. It's such an arbitrary thing. And so when people come to us and say they want these discounts to something, we just kind of move on, because we're just not gonna, we're not bottom feeders. That's not where the market is. If it cash flows a certain number, then it works. And the same thing goes for a seller who says, well, I want 1.8 million. And you say, well, all right, so we're dealing with this now. So, the seller wants 2.3 million. And we're like, at a 7 cap, it's at 1.6. You're in a fringe area, a 7 cap. The property needs 300,000. The properties need 300,000 as a capex, and that's going to bring the buyer down to a 6% yield, and that's their threshold. And you want to sell it at a 3.5%.
Yeah, you're going to run off all the buyers.
Well, you go sell it on the open market one at a time. Kick all the tenants out, and you're going to lose about 8 to 10% by doing that. And that's something that we haven't talked about so much, that you don't have to vacate a property to sell it. So we get realtors. You go to a realtor and say, I want to sell my investment property. They go, great. When is the tenant out? Because we're going to need to get the tenant out, fix it up, and sell it. And you lose about 8 to 10% of friction costs of your payment, not getting the rent and fixing the house up. And then however long it takes it to close and all those things, where you could sell it for maybe a little bit less than the open market. And this is assuming that the income and that retail value are close. If it's something where it's appreciated $400,000, then that's different. But
yeah,
typically, and so there's 1 million investment property transactions that happen every year, and it's something that we're trying to shine more of a light on, and especially even with realtors who work in this world, and they're working for brokerages that focus on getting homeowners. They don't have the support that they need to work with investment properties, and so that's why we're trying to bring in a lot of those type of people. But you don't have to sell your property vacant. You can sell it as a tenanted asset, and it's becoming less of just a little niche market, and it's becoming more of a mainstream market where you can find a place to buy and sell. And so that's what's really exciting for me, and as an evolution of the space continues.
Yeah. Yeah. And we've gone back and forth. We sold untenanted properties and there were some problems with that. And then we started selling tenanted properties. There were some problems with that.
Of course.
Now we do a little bit of both and
Yeah.
it all works out well. So I want to take a break just for a second because speaking of good deals, I've got Nicole standing by to give us the home run of the week. So take it away, Nicole.
Hi, this is Nicole, your Director of Investor Relations at High Return Real Estate. Did you know that we do 2 third-party inspections on every property that you buy from us? Yep, that's right. One is before the rehab to make sure our crews address all items needing repairs. And the second one is after to make sure that you get a property in excellent condition. Interestingly, these come back with an overall rating of 1 to 10. Well, today we are proud to present a perfect 10. I'm sure you're going to want to learn more about this nice little number on Tacoma Street. So just send me an email at homerun@highreturnrealestate.com. That's homerun@highreturnrealestate.com, and I'll be happy to send you all the details. Talk to you soon.
All right. Thank you very much. So back with Noel Christopher and having a very, very frank and wonderful discussion. So I know you're very involved in this marketplace, and I want to ask you because I kind of want to compare notes here for a minute because, we're in the turnkey space. You, to a certain extent, are kind of in a different way in the turnkey space too. But what are you seeing are everybody's got different ideas. We talked about buyers and sellers may be looking for different things, but buyers right now, as this market evolves, what is really the top few things, maybe it's 10, maybe it's 7 things that buyers are really looking for and insisting on right now?
So I can kind of break it up in 2 ways. So we've got the individual buyer who is the majority of the market that's buying 1 or 2 homes. What we're trying to guide them, I guess, more than what they're looking for, because we get a lot of people coming to us not knowing. They've either gone to a real estate investing class or they've watched a podcast or, we've had some people come to us from a local company there that hasn't been doing too well, that I'm sure that's been in the news a lot. It's when they come looking and they say they were promised 20-25% returns. That's always, you've got to be realistic. You've got to look at what, and I don't know what the returns are there in India and what you guys are doing, but we really are trying to guide them and say, look, what's your financing? If you figure that out, then you need to look at your return and you need to understand that if you're going to do this, this is a strategy. You don't just want to buy one house. You want to buy a few so you can start to diversify your risk. But a lot of buyers are looking for what we're seeing, and this goes with investors or larger or mid-sized, large investors to small investors, areas where there's job growth. Lower cost areas are great because you're going to have tenants who aren't leveraging everything they have to live in a house. And what I mean by leveraging is that they make you want to have tenants that are at that below 40 to 35% of their income is going to housing, not 60%.
Yeah,
because you're going to have a safer investment. Understanding the rehab. We've seen a lot of issues with houses that, because the margins are getting squeezed, corners start to become cut. You start to cut corners in order to make that margin. So it is better to go directly to you, Shecky, and buy a house than it is to go to the investment club you pay money to, who then has an agreement with a turnkey provider that pays them something, and then they're buying it from that provider on the ground, and there's some equity taken out of the deal.
Yeah, or just additional markup. Additional markup, all the same thing. Yeah. It's interesting that you say that because we have now. We've done such a good job on our rehabs and our processes that we got well known for that. And so we actually have a couple of fulfillment clients, kind of like our big secret that's not a secret anymore. But where they just, they have other things that they do. They have 401k administration and a number of other things they do. And they offer some things that we don't offer, financing, et cetera, et cetera. So I'm not saying that there's not a value add there. There absolutely is. Otherwise, we would not have agreed to provide them with those properties. But I know that they are, because I see the purchase agreements. I know they're taking our stuff and they have to add another layer of markup on it to make their numbers work. So it's interesting what's going on. And there's a lot of, referrers and marketing channels. And I mean, there's a lot of people trying to, like you say, the market's really evolving and, the demand is there. And that brings a lot of people that want to have their fingers in the pie.
Yes. And so, and as margins and you get a little bit squeezed, some of those people get pushed out. And at the same time, it is much easier to market directly and get in front of buyers and do it yourself. And I see a lot of that. And there is some benefits to that, to especially wealth management and some managers are helping manage people's money and they kind of put them in the right position. I'm just seeing that it's not, you don't always have to, when there's the more layers there are, if you get more than like one layer or two layers, maybe it starts to get very dicey because just to make the numbers work, it's better to go directly to you is what I'm saying. And so we always advise people like, and that's why we're not in the turnkey business. We have a marketplace that serves a purpose and we earn a commission. But we're not trying to get in that business. And we might get in the turnkey business. I mean, we've looked at it in some other markets and at some acquisitions. And that's how we met, was talking about you maybe getting out of property management, letting us acquire a company and then continue to work together. So we do some of that stuff, but we really want the buyers to understand that there are no guarantees in this world and in real estate investing. And if you buy one house, over a period of years, you're going to have some issues. It doesn't matter if it's a brand new construction house. I mean, what people sometimes don't get is they'll buy a brand new construction house and accept the fact that over the years you have to do maintenance and you have things break and stuff happens. But when you buy an investment property, they seem to think that nothing's supposed to ever break and you have a tenant living in there that doesn't own the house. So you have to accept the fact that this is real estate investing. There's things that happen and that you need to be prepared for those. And so I always am cautious when people come to me and say, man, I can buy this house and it's got a rent guarantee and maintenance guarantee. I'm like, well, what happens after that? Like, well, I don't know. What happens? It's like, well, not that those things there's situations where those can work. And the ones I've seen them work, I'm not sure how you guys do your stuff, but where it's like, here, we're setting from the sale of this property, we're setting money aside for maintenance. And this is a maintenance reserve fund. And it's not a guarantee. It is, we just, as a service, you set that aside. And so cautioning to that stuff,
Yeah, there's a lot of different ways to skin the cat. And it's interesting what goes on in our industry because I've been somewhat averse to rent guarantees and maintenance guarantees and things like that. So like when people are buying a property from us, we're doing a very, very thorough rehab and we've got this huge checklist and we actually do 2 different inspections. We do one up front when we acquire the property. So we're getting a really good look at that property before we start rehabbing it. And we've got another set of eyes on it besides us. And then when we get done, we do another full one. We don't ask for a review. In fact, we insist on a different inspector.
Great.
So we're bringing in a different set of eyes to look it over. And even with 2, there's some stuff that our guys miss. And then we'll go back and cure those inspection items and have our guys sign off on it and take pictures and things like that.
Sometimes somebody has to live in it for a little bit.
Well, somebody's got to live in it and, it's going to get beat on. And so we're very confident in the rehab processes because of what we do, but we offer a warranty on our product. So it's not what we would call a maintenance guarantee because the fact of the matter is 2 months in, Josie's going to flush a diaper down the toilet and plug it up. Right? That had nothing to do with our rehab.
Correct.
And so I never wanted to put our company in a position where we had to really offset a kitty or cash to predict unpredictable things. right? It's just silly. Now,
Not enough margin in the business for you to do that.
no, exactly. And so, we're making it up on volume. We sell a lot of properties, but if we only sold 2 or 3 a month, we would starve. And so what we do is we just do a 6-month warranty on the property, but at the same time, that's only major systems like roof, plumbing, foundation. Yeah, we're warranting our work, and we're saying, look, we did a good job, but you are an investor. There is some risk involved. There's weather, there's, unpredictable tenants. There's just stuff that just happens to break from wear and tear. Sometimes
job loss, death, taxes, all of these things affect
that. Exactly. So we've even gone so far because you bring up an interesting point about investor expectations, that we have our investors sign an affidavit when they're signing the purchase agreement. I understand that this is an investment. I understand, I understand that I got a warranty, but it's not covering unpredictable. It's just covering your work. We're really clear about that now. But we've learned, because we've had many investors over the years come back to us and said, well, you said this and you said that. Well, we didn't really say that. We said this is how the property is performing right now, or how it will be performing once it's rented at a marketplace rent. Here's what we anticipate expenses being, but there is going to be some variance in what our anticipations are.
Yep.
So I think that this is why I ask you, what are the things people are looking for? And it's interesting that you not immediately, but you gravitate towards a conversation that kind of makes me nauseous a little bit, because I hear it over and over and over again, right? And it's just like, guys, it's still an investment, and there's still stuff that can break and go wrong. And you bring up a really, really good point, and this is what I find interesting. There's a lot of new investors entering this world of real estate investing. There's a lot of gurus out there, and educational products, and free education, and YouTube channels, and there's just a glut of it. And some of it's good and some of it's bad. And so, everybody wants to be, the next Robert Kiyosaki. And I was about to say Donald Trump, but nobody wants to be Donald Trump anymore. They think that buying one little single family home, this is the answer. But, you bring up a good point about diversification. Unless you've got a few doors and are spreading that risk, then what ends up happening is you get into that mindset that all of my investment and everything about my success or failure in this is based on one goddamn door. And it's just not the case. You know that, I know that, and most of the investing world knows that. But unfortunately, many new investors don't quite grasp that concept.
And that was my point with that. It's as there's so much interest in this space, that is just setting those expectations and having people understand. That's why sometimes I have a really hard time using the term turnkey, because this isn't a triple net lease property. Right. For me, a turnkey property is a Walgreens. You buy the land, build it, and Walgreens rents it for 100 years or 50 years or 25 years or whatever, and takes care of everything. An investment property, you have to actively be involved. Even if you have a great property manager, you want to know everything that's going on. That's why the rent guarantee thing drives me crazy, and even the maintenance guarantees, because you're not actively involved in what's happening in that property. So then when that all gets cut off, and many times it's because that company goes out of business because they can't afford to keep up those things, right. You're in for a shock. So and that's why we talk about that 5-year period. I talk about that a lot, because if you can get through that 5-year and you're actively investing, things start to get really interesting. The cash flow gets interesting, the appreciation, the diversification. And if you can get to, 10 or 13 properties, then it's really interesting because of that diversification. And, so we talk to people about that a lot. Now, when we're working with some of these bigger investors, I call them mid-size investors, they're looking for areas, the same thing, job growth, quality of build, because they're buying a lot of existing portfolios. They're looking to they don't mind being in the suburbs, but they don't want to be in the exurbs, because if there is any kind of a recession, those really far areas get usually hurt worse, because people want to move closer to where the jobs are. And what's interesting now is that it's no longer the top 10 markets or top 15 markets. It's the top 100 markets, because and this is relevant to the people that listen to your podcast, the friction in not only doing real estate transactions, but managing a property, getting the information, understanding a market, doing the research, all of those things is getting so much easier, so much less friction that you can understand a market being remote and you can acquire homes remotely. And so if it can be done by somebody who wants to buy a couple of homes, it can definitely be done by somebody who wants to buy 1,000 homes. So
Yeah.
you've got these funds that are coming in and they want to buy 1,000 homes in 100 markets.
Yeah.
And it's now possible. And all of that's great. Some people look at it as, well, it's more competition, all that kind of stuff. It's not. Those efficiencies that the funds are making, and companies like ourselves on the property management side, that we have some big funds we manage for, we have to create efficiencies, and that all rolls down to our small investor. We're a company that services small investors. That's our focus. We also service some larger investors, but the efficiencies in the space are happening. I think what is interesting is that it's been so good for the last 8 years and the returns have been so great. As things start to level off a little bit, as they take the gas off the accelerator a little bit in the market, the inefficiencies that some have been dealing with and some of the property managers and providers and things like that, they've been getting away with because it's just been so hot, those are coming to light and it's shaking up the industry a little bit.
Yeah.
Same with turnkey providers, same with investment clubs, same with property management companies, everybody. You're having to up your game a little bit, which is great. It's raising the level of service in the space and it's pushing out some of these guys. I mean, we get a lot of pushback from other property management companies because we are becoming more efficient at a lower price. And some of it's because of scale, but a lot of it's just because it's changing. And people who are leaving a little bit of money on the table each time they turn to property or their rents or things like that. Now they're not even through a professional property manager. You can go out and find what a property or rent for. You can self-service manage your house. You can have somebody manage it for you and be more efficient. So
Yeah, that's interesting. There's some hybrid models coming out in the
Yes.
property management world too, and that's a whole nother podcast. But I'm looking at the clock behind me, and
Sure.
we're running out of time. But I do agree that I love what's going on because, like I said, the trees are getting shaken up a little bit, and some of the less than great providers in all areas, you're talking about property management, lending, turnkey, all that kind of stuff, are, the light is going to start shining on them as not being really the best places to best people to work with. But I think it's driven partially by that, but it's also driven partially by technology. So I know you and I both share that love of technology, and I really think that's fantastic. And I think there's going to be some really, really interesting things that we're going to see in the next 4 or 5 years in this industry that really are game changers. And it's going to make it even better and even greater for, what I would call the armchair investor sitting at home. And I'm excited about it. I mean, we like to think we're a progressive company, and it's hard to change, but, we're working hard to roll with the punches as the technology changes and adapt more and more to that stuff and use it to our advantage and to our investors' advantage. And I know that not everybody's like that. Human beings in general are somewhat resistant to change, but we're in an environment where things are changing faster and far more exponentially than what our little pea brains are capable of getting our brain around, so you just kind of got to bite that elephant one chunk at a time, right? So
Agreed.
In any case, I think this is a good spot to sign off, and I could talk to you all day, and maybe we'll pick another topic sometime,
Sure.
and ramble on about that. But Noel, I want to thank you so much for your insights, your expertise, and really your commitment to excellence in our space. And it's fantastic. And I thank you for being on the show. I know I got a lot out of it, and I'm sure that our investors and listenership did too.
Excellent. Well, I appreciate being on the show, and it's always a pleasure.
Oh, and last question is, how, if people want to follow you and find you, especially the marketplace that you had talked about, how do they find that?
Sure. Renterswarehouse.com. You can go to our marketplace. You can find properties to invest. You can find about our property management. We're in 41 markets across the country, not in Indianapolis. Someday we will be. Myself, I'm probably the most active on LinkedIn. So look me up on LinkedIn. I do a lot. I put out a lot of content there because we're actively looking for portfolios of homes to buy for some of our investors. And that's probably the best place to find me. And if you ever want to, you can connect with me, you can follow me, you can ask me for a meeting. I love to help. And you know, I'm of the philosophy of giving away as much information. If you're teaching, you're learning. So I love to share what I know, and it's a lot of fun. So I appreciate the time.
Awesome. So we'll put that link in the show notes.
Okay.
And it's renterswarehouse.com. And then you just go to find the link.
Go there. It's all really easy to find a marketplace. And,
okay.
My LinkedIn is linkedin.com, Noel Christopher. So really easy.
And if you can't,
there's not as many Noel Christophers out there. So.
Okay. That's good. Well, thank you, Noel. Really appreciate you. And thank you, listeners. Have a beautiful day.
Thank you. Bye-bye.